And to show you exactly what that looks like on a chart, let's go back over to our Analyze tab again. We're going to X out this option. Let's go into the, let's go expand the strikes a little bit. Let's take a look at a few more strikes here. We're still in the Diamonds ETF, and we're looking at the 120 January calls at selling for $3.30. And again, the time value of that option is $3.13.5. Let's sell one. Instead of buying an option, let's sell it. Volatility is low. We've got a premium of $3.30 for this particular option. And we think that the diamonds are going to stay at 120 or fall below 120. If it goes above 120, we start to lose money. If it stays at 120 or falls below 120 by expiration, then we've been able to capture the entire profit of this option that we've sold. Let's go over to the risk profile and take a closer look. This is what it looks like. The red line is the expiration, what happens to this option at expiration. The white line is where we currently are. And let's adjust our volatility back to a normal level. So the current volatility for that option, like I said, is $15.84% implied volatility. So remember our Vega. Our Vega is extremely important. If we think Vega is going to increase, it will affect the price of our option. Obviously, the price of the option will go up, and we will lose money. So selling call options is a difficult proposition unless you're absolutely right on the direction of the market, because normally when a market falls, the volatility increases. And even though the market might fall, the Vega of the option will increase, offsetting sometimes the gains that we would receive from the selling of the option. Now the theta is what we're going to be talking about next. The theta is the amount, theoretically the amount. And I have to say theoretically, because it doesn't always work this way in real life. When you start selling options, you'll say, the current theta at the current price is $4.09. I should be able to gain a profit of $4.09 per day from this option, and that isn't always the case. There are other factors involved in theta. It's not a straight line. It's not the type of line that you would normally consider straight to expiration that would give you this profit. In other words, it's not going to follow this white line all the way to your maximum profit. Even if the market were to stay absolutely still, it's not a perfect line to your profit. Let me give you an example. Today, we're starting out at a certain date, and we have a theta we have a delta of minus 52.64, so we'll gain $52.64 for every dollar that the diamonds drops, as long as Vega stays the same. Now let's increase the date and watch this white line. The white line is our profitability line. So even if the market does not move, we should be able to gain our near maximum profit on this position as long as the ETF stays at 120, because we sold this option. And remember, any option out of the money at expiration expires totally worthless. So let's increase the date here and see what happens to the profitability of our option. There's two things that we want to watch. Number one is we want to watch our current P&L open right here in the spreadsheet, and we also want to look at our profitability line up here. Okay, as time goes by, we gain approximately $4.24. Actually, the theta increases the closer we get to expiration. There's more money that we receive in terms of income from writing this option through an increase of theta the closer we get to expiration. So let's keep going. We're gaining about $4.24 theoretically now on this particular option. Now the price of the underlying ETF has not moved, but watch what happens as we continue to move forward in time. Now we're gaining approximately $4.36 per day as the day increases. However, Normally what happens is, in order for you to be profitable, right, you've sold a call option. That means that the price of the ETF has to either stay the same or go lower. So let's say we go lower. You see what happened to our delta and also to our profit?